Evening, everybody. Oops, I think it's a bit echo. Good evening, everybody. Hope you're all doing well at home. Welcome to our, well, once a month at least, Tuesday live stream on the SGX. But today's really going to be quite an interesting topic. If you can hear me okay, can you just say hello or hi, that I can see that, I think you can see me okay, just to make sure that my mic is working well. All right. Just give me a comment and say okay. Yep. All right. Okay, so we're gonna get started. Today's session is really gonna be quite interesting. We were supposed to do this last week, but due to uncertainties, I had to postpone last week's event to this week. I think in the last month or so, we've been seeing quite a fair bit of movement in the stock markets, crypto markets as well. That one word that the Federal Reserve has said that they will be tapering, and that they're going to be increasing interest rates up to 3 times in 2022, right? So that kind of spooked the market, and all markets have come down crashing. And I think for a lot of investors today, you'll be wondering, can I still invest? Can I still look at stocks? Are they still investable, right? Because the market's reacted so badly, right, to the increase in interest rates now. So tonight's session is a little bit about economics, just to give you an idea. Before you make any rash decisions, I just want to give you the facts. And then you can decide, and then of course I'll share a little bit on some of my views as well. At the end of this, I will also be talking a little bit about the Singapore budget. So how does this affect some of the SGX listed stocks as well? Because the budget just came out not more than 2 weeks ago, right? So just a little bit there, and what we're seeing, different countries doing different things, and of course, I think the kind of the hot topic now is trying to manage inflation. And I think if you have been reading the news, you would have seen palm oil prices. Palm oil for the first time is the most expensive edible veggie oil in the world today, right? More expensive than sunflower, rapeseed, or even soybean, right? And that's why you're seeing some of these plantation stocks move up right now. I think partially one of them is because of what's happening with Ukraine and Russia right now. A lot of the ports have been closed, and a lot of what sunflower oil actually gets shipped in the Baltic Sea. So that's because of the conflict that's been shut down. So there's been kind of an immediate shortage of edible vegetable oils. So we're seeing a little bit of that. So of course, there is one listed company related to palm oil on the SGX, right? So of course you can check that out as well. Now, what we're going to do now is I'm going to just share my slides here. Of course, quick disclaimer, none of this is meant to be financial advice. A little bit educational, so I hope you guys can sit back, enjoy, and relax. Now, of course, if you guys have any questions, please don't hesitate. Just ping me, and we can engage in that discussion. Now, I think we see a lot of this thing called tapering tantrum. Now, what does it really actually mean, right? I think very simply, what it means by tapering is that the central bank, basically their main goal is to make sure there is a stable economy. They control inflation through different means, right, for them to have stable prices, right? Now, so one of the tools that they use is actually the use of interest rates, right? So which means that if they increase interest rates, they hope that people will put more money in the banks, put money in the savings. Therefore, there will be less I won't say less economic activity, but it reduces the the amount of circulating money supply, right? Therefore, trying to reduce interest rates. So we're going to talk about that and a little bit of how effective are these tools in this day and age, right? Because if you have studied economics in the last 20, 30 years, normally increased interest rates, economy will slow down. And I think right now, if you look at the knee-jerk reaction, it's probably a little bit overdone, right? So, of course, the opposite of tapering is quantitative easing. What is quantitative easing? Is basically the central bank just creating more money, right? More money supply. They just create out of thin air. Now, we use the word printing money quite loosely. Printing money, for most of us who grew up with actually paper currency note, you can envisage what printing money means, right? That means you just print money. Nowadays, the printers actually don't have to switch on. They're all done electronically. It's just a debit and a credit, and money appears in the bank, right? Credits. So really creating credits out of nothing, right? And of course, this is probably the main concern amongst all investors, and that's one of the reasons why you're seeing the popularity of things like cryptocurrency rising up. So if we look back a little bit into history, right, about tapering tantrums, is this the first time we've seen something like this? Absolutely not. This is not the first time. Has this happened before? Yes, it has happened before. Now, I think more predominantly in our short history of what we call quantitative easing. In fact, quantitative easing as a term kind of grew mainstream in 2008, 2009. So it wasn't too long ago, it was 12, 13 years ago. If you look at what happened was in 2008 financial crisis, because of a lot of mortgage-backed securities, a lot of banks were actually collapsing, right? So to prevent the banks from collapsing, what the Federal Reserve did was they just printed money. I'm going to use printed money very loosely to show up some of these banks, right? And that's why they came up with the word, quantitative easing, because they wanted to stop a bank collapse, right? Because if the bank collapse, the whole economy collapses. Now, what happened was after that, slowly as the economy started recovering, the Federal Reserve or the central bank started printing less money, right? They started printing less money because you keep printing money, it's actually going to be bad, right? So they have to slow it down at some point as things were improving. And of course, we got a reactionary panic, right? Stocks started coming down because you get so used to easy money and low interest rates, people get scared. But really, if you look at the whole history of where we are today, when central banks actually increase interest rates, it means that the economy is recovering, right? And typically, right, if you don't have time to watch this whole hour, but typically when you see signs where banks continuously be printing money, right, and also reducing interest rates, when they actually start increasing interest rates and they start reducing the printing of money, typically that's when we know the recovery signs are already there, right? So we're probably just the beginning of a bull market, right? And if you look back in the last 12 years, when they started to taper, of course there was a knee-jerk reaction, obviously, like exactly what we're experiencing right now. But fast forward after that tapering, and you go fast forward 5 to 7 years, the stock market is higher than where it was at the peak even before 2008. So I think there's much to rejoice that interest rates can move back up. Otherwise, if it keeps going down, we know we know the economy is in a pretty bad shape. And I think in the last 2 years, the economy has been beaten up quite badly because of COVID. And typically, when we look at market cycles or crashes or depressions, right? You're gonna normally see that these downward negative GDP growth or recessionary periods, they last between 18 to 24 months. I think we're coming close to that 24-month period of the recession, and that's really when the recovery period actually starts, right? So I think right now we're actually probably in that recovery period stage at this point in time. I guess, when everyone's fearful, Buffett always says, yeah, it's time to be greedy, right? Now, just to give you an idea very simply, how does the Fed actually create money or print money? Very simple. What they do is they buy treasury, right? So whenever they buy IOUs, right, they buy bonds, they create money that way, right? So they put more money into the system. So just like you and I, the central bank actually has assets and liabilities as well. So if they keep buying more and more assets, they are actually giving out more and more money. There's a lot of liquidity in the market, right? And we're going to look at how interest rate increase affects other things, and then eventually we'll kind of link it back down to the stocks as well. So if you kind of look at this, if you look at how the Fed has printed money, you just need to look at their balance sheet, right? So if you look at this up to January 2020, when the Federal Reserve said they are tapering, they are not stopping. That's a big difference between stopping and tapering. Tapering means slowing down, right? So obviously we cannot be printing money at the same pace as we were in the middle of a recession and a pandemic, a global recession and pandemic, right? So I think it's natural for the Fed, the central bank, to actually start slowing down, but they're not stopping, right? So if you look at 2008, their balance sheet was 1 trillion. In 2013, even when they said they started to taper, it still grew to 4.5 trillion, right? And it kind of remained there for a while, took a small dip. And then it's actually doubled, right, in the last 2 years. Now that's an immense amount of money that was actually created in a very short period of time. So, and I think, we get a lot of these questions. Often I get a lot of these questions. It's like, how can, the US keep printing money with no regard, right? But the ironic thing here is that the US is probably the only country in the world that can continuously print money and or borrow money that they will never have to repay. Right? Repeat this again, right? US is probably the only country in the world where they can keep borrowing money without actually having to repay. Now, why do I say this? Because when they borrow in US dollars, they have the right to create those US dollars as well. And because 80-90% of the world's trade is still in US dollars, right? People are still willing to accept. People like you and I are still willing to accept and give US dollar a value, right? Therefore, it still remains relevant. So really, I think this is really the only country in the world that can do it. And when they say superpower, they are a superpower in terms of finance or money. When it comes to money, right? The US. So really, they can be as irresponsible as possible. In terms of government budgets, they are always in a deficit situation. It doesn't bother them because they just create something out of nothing. They literally can buy anything for nothing, right? So that's what the US is. That's how they've been continuing to become a superpower, right? After all these years. So if you look at how money is actually being measured, very simple. I think if you've done economics in high school or in university and you've forgotten all that, that's normal. But really, they measure money based on what they call M, right? M0, 1, 2, and 3, right? Now, I don't want to go so much into the details of what they actually mean, but very simply, M0 means the coins and notes in circulation. Normally, this is a very small amount of total money in circulation, right? I'll give you an example, right? If you are, oh, no sound. You guys hear me? No sound. Thanks, Darren. Test. 1, 2. Okay, good. Darren, are you okay? Okay. Now, so if so, I'm going to continue if you guys are okay. So when you come to M0, really, it's notes and circulation. So it's a very small, like 1% of total money supply. Why do I say this, right? If you're going to buy big ticket items, like if you say you're going to buy a house, or today, if you guys invest in the stock market, you don't use paper money, right? It's all numbers on a computer that you pay with, right? So most of the money that we use today is actually not in paper money. And now, with advent of e-wallets and digital currencies, this is probably going to get smaller and smaller. So one of the next level that you can measure is what they call M1, right? That means what is the balance in your bank accounts, your current and your saving accounts. That's notes in circulation plus your current CASA, right? They call it current account or savings account, right? That's what's known as M1, okay? Now, of course, then you must look at M2 as well. M2 is probably the closest you can get to what is free money that's being circulated right now. So that includes your FDs, right? And any money market funds, right? So M2 is really kind of, if you think of it like your engine oil in your car, right? It keeps everything circulating. So this is really that amount of engine oil in your engine right now that keeps circulating, right? Now, so one of the key components that you must measure to see how much money is being created. When I say money, I mean fiat money or money that's just printed, right? Printed money. Let's take the printed money for now. I'm going to use it very loosely, right? If you look at this slide here, you can see, right, just based on M1 itself, that means your CASA and your notes in circulation, you're actually going to see that that has grown by 900%. This is the US dollars here. This is M1. M0, you can see, which is notes, is only about 400%. M2 and M3 is 300+%. So you're seeing actually there's quite a bit of money that's actually being created. Now, if you look at the US right now, if you look at this, you can see after 2020, the amount of money that's been created is literally one way up. It doesn't go down, right? So obviously it's natural for them to taper, but we have to remember this, right? They're tapering now from a much higher base, right? So if you kind of look at it before, if they were at 200%, and they jump up to 500%, even if they slow down by a little bit, they're still slowing down on a new base, which is much, much higher, okay? And look, Europe is the same. If you look at COVID, they created even more money. China is the same, right? So if you look at every country in the world today, you're actually going to be the same, right? So if you look at M2 creation, the amount of money that's being created, if you look at EU, Singapore, USA, Malaysia, or even China, this time we're not number one now, we're number two. Now, but is it normal for a country to print money? Absolutely, right? Because as the economy grows, the GDP grows, there's more economic activities, cities are built, there are more and more transactions. You need more money supply, otherwise you will kind of stagnate your economy, right? And I think it's normal, but it's really where what we're talking about is probably irresponsible amount of creation of money, because it almost seems that globally, the leaders around the world actually have no other choice, but that's the path of least resistance, is just to create money, right? During COVID, what do? Let's just create money, ask everyone to stay at home. We'll send them checks, right? Ask them to relax. Let's figure it out, right? Because I don't want to be voted out of power, especially democratic countries, right? So every country in the world creates money. I guess the question is, to what degree do they create? To what degree? Okay. So if these are some dates for you guys to take note of, right? Especially investors like you guys. If you wanted to know, right, the central bank in the US actually meets 8 times a year. All right, January, March, May, June, July, September, November, December. Now, this is where they decide, are they going to increase interest rates or reduce interest rates, right? And typically, these announcements actually have an impact on stock prices directly, right? So, as you saw what happened in December, straight away the market tanked 20%, right? But I think what they do now is slightly different. So maybe 15 years ago, what they did was, it's a surprise. At the end of the day, they'll give a briefing at 5 p.m. and say, interest rates are going up 25, 50 basis points or going down 25 basis points. And then the market will react accordingly. But now what they do is that they will tell you ahead, way ahead, to say, hey, you know what? Next year, I might be increasing, the interest rates 3 times, right? So the market kind of compensates for it. So right now, markets being down has already factored in. Now, the question is whether it's an overreaction, that's something that, let's look at it historically, have a look and see, whether it's really an overreaction, right? So this is the US Federal Reserve. In Singapore, it's actually twice a year only. They meet twice a year. April and October. Now, if you guys want a copy of these slides, we can make it available to you. Not an issue, right? So we'll send you a link later. You can download it. Bank Negara, they do 6 times a year, right? So January, March, May, July, September, and November. Okay. Now, I think let's look at a couple of scenarios here. So when we did analysis, we want to look at a couple of scenarios here. Now, the first scenario here, I know we're talking about US, right? That they're going to hike interest rate 3 times. Their excuse is that inflation rate, they're trying to control inflation rate. Okay, so let's look at it historically and look at and see whether there is a correlation between interest rate increase and reduction in inflation. Okay, that's the first thing. Second scenario is that there's no change. All right. Third scenario is that they will cut interest rates even lower. Right now, interest rates are already almost at the bottom. Right, probably only 25 basis points to 0. So these are 3 likely scenarios: either go up, like what they mentioned, no change, or go down. Right. I think most likely it will be an up. If I want to give you the conclusion very quickly, most likely interest rates will go up. But I think stocks will go even higher, right? Not lower because of that, right? From the current level they are today, okay? And I'll explain a little bit. I explain in a little while why, okay? But that's my personal view, not financial advice, all right? So what happens here when you increase interest rates? What they're trying to do? They're actually trying to reduce the money supply in the system. So when you increase interest rates, the whole idea here is that, you know what? Oh, you increase more interest rates, I'll put more in the savings, right? Therefore, I will have less spending, therefore less velocity of money, therefore lower inflation rate. So it's a demand thing, right? So what happens when you increase interest rates? Loans become more expensive to service. Borrowing becomes more expensive for growth, right? And more people will save, right, and reduce inflation. So let's kind of take a look at whether inflation rate actually does work, right? If you look at this, my mouse here, if you look at US has historically kept interest rates very, very, very low for long periods of time, right? They only started rising in 2015 to 2018, right? In fact, 2019, it already came down. This was pre-COVID. And of course, once COVID hit, it stayed down a long time. But you can almost see really there isn't a... So if I go back to the point here, even though interest rates were high, right, here, it actually did very little for inflation rate, right? So if you almost look at keeping interest rates constant, inflation should be continuously going up, right? But it actually didn't year on year, if you look at it. So it remained pretty stable, right? Now remember, inflation rate is something that all central banks in the world are trying to maintain. They don't want inflation rate to be 0. Okay, their target is 1-2% a year. That's really a target built for them, right? So that everyone feels a little bit richer, notionally we have more money, right? So that's why 30 years ago you could have bought maybe a house for 30,000 ringgit, right? Today you can't even buy a room for 30,000 ringgit, right? So everything looks more expensive, pricier, but really you need to look at purchasing power parity. So if you look at correlation versus investment, right? So the lower interest rate, the higher the investment, right? But if you that's the ideal. That means you keep interest rates low, then people will take more of their money out and go invest it, right? If you really look at some of these charts here, actually we're not really seeing that correlation. That if you can see, interest rates went up here, right? Even at the peak, investments still kept going up, right? Now the only reason why investments came down was because of 2008, 2009. It wasn't because interest rates went up, right? Now, of course, they kept interest rates low. On top of that, when they started increasing interest rates, actually stock markets continue to go up. The only blip that you see here is actually COVID, right? So I think we have gone past those economic theories that that's been written as theories that if you increase interest rate, therefore investments will come down. Actually, that is not true in the last 20 years. Actually, we've not seen any correlation there. Here's another graph here to really give you an idea on foreign direct investments, right? FDIs are also not affected. Even if you keep it high, if you look at it, FDIs continuously go up over a period of time. So really, do interest rates really matter that much, right? Even if the Fed was going to increase interest rates 0.25 and say 3 times, right? So you go to 1%. We really don't think at this point in time that 1% is going to make that big difference in actually trying to reduce investment or reduce interest rates, right? And that's where I'm going to share a little bit about what Singapore has done, which is quite interesting, right? So, if you look at this graph here, the dark blue line actually shows you interest rates, right? And you look at inflation rate as well. So if you really kind of look at this, by right, if you keep interest low, inflation should go up, right? But in fact, inflation was coming down here in 2012, 2013, 2015, right? So really, actually, there is no correlation right now we see in modern economics that we see today. Actually, increasing your interest rates even 3 times today is not going to make a change to inflation, right? If you look at, there's no correlation, right? And this is the STI versus the S&P 500. Now, how do they look like when we talk about stock markets, right? If you look at the light blue line there, you are actually seeing interest rates, right? So going up, going down, going up, going down. We see no correlation apart from the 2 major market cycles in 2008, right? And COVID, right? That actually stock markets will go up regardless, right? Whether you increase interest rate or not. So if you can see here in 2005, they kept increasing interest rates here. The markets kept going higher and higher and higher, right? Similarly here in 2016, they increased interest rates, almost fourfold. But stock markets actually kept going higher and higher and higher. So to the investors right now, what is interesting is that I think, everyone's kind of shocked that suddenly they're going to increase interest rates because, when the good times are rolling, people forget that, these good times cannot keep rolling forever. You cannot keep getting free money for nothing, right? But if you look at this chart here, what is actually quite encouraging is this, right? When they actually start increasing interest rates, it means that the economy is improving. That's why that's why my analysis is this, right? It's really actually a really great time to be in. If you're timing the market, it's a really even better time now because markets have dropped 25. Some stocks in the US dropped 50%, right? They've dropped at least 20-25% since December, right? And if the economy actually improves, a lot of the fundamentals of these companies will actually improve, but you're buying it at 20% cheaper prices, right? Than they were 2 months ago. So again, absolutely no change, right? In sentiment wise in terms of interest, right? So really the current tapering tantrum that we're seeing today in my opinion, it's very much a knee-jerk reaction and probably overreaction. Okay. Now, what we do see correlation is with bond prices, right? So obviously, if interest rates go up, then your bond prices will come down, right? So, so that's quite. I think that is probably the only correlation that is still relevant today, right? Of economic theories that we see today is still relevant today. But no, increasing interest rates will not actually reduce demand for investment. Increasing interest rate actually does not reduce inflation anymore, right? Now, what we're seeing here is the question is, does increasing interest rate affect commodity prices? As you can see here, actually it doesn't, right? It doesn't, right? If you reduce interest rate, does it go up? It doesn't go up immediately as well, right? So what we're actually seeing here today is, again, there is no correlation between commodity prices and interest rates as well, right? By right, if they increase here, commodity prices should come down. But if you look at this commodity price, this is not normal, right? This was COVID in 2020, right? So what we're seeing today is actually what we covered last year. If you can remember, you look back at some of the videos, we talked about the commodity super cycle. And that's why you're looking at oil palm prices at all-time highs. But these are all due to logistics. There's not enough labor. The ports are all choked up. Now there's war in Ukraine as well, right? So a lot of these other factors actually has pushed up the prices of commodities, right? And the fourth one and most important one, because commodity prices have been fairly low in the last decade, there have been underinvestment in this space, right? So when there's underinvestment in this space, suddenly when there's a demand for more volume, and especially with commodities, it takes time for you to extract gold or silver or copper off the ground, or even talk about oils, right? Soybean, palm oil, right? Palm tree needs about at least 4 years to mature before you can extract anything out. So in this next 2 to 3 years, we're probably going to see a shortage in some of these commodities as the economy pick up, right? So interest rates, in my opinion, actually has probably very little or nothing to do with commodity prices, right? Again, does it affect Forex? If you look at this chart here, we don't think so. We see no correlation. So, which means that if it goes up, it should also go up. If it comes down, it should come down, right? The theory is this, right? As your interest rates go up, your currency should strengthen because it attracts more foreign currency, right? But generally, if you look at globally, the whole world today, interest rates are fairly low, right? Across the board, everywhere in the world, right? So, so we're not seeing a change in Forex as well, okay? Of course, the second scenario here is that everything remains the same. We think that is quite unlikely going to happen because I think governments around the world realize that in the last 2 years, they've probably created too much money in too short period of a time. And now that the economy is reopening again, and when they created so much money, they need to figure out a way to actually reduce that money supply, right, without hurting the recovery process. So I think governments around the world are doing different things. In the US, because it's generally more populist-based consensus, they actually can do things. They actually can increase taxes if they wanted to, but they have chosen not to go down that route. Instead, they increase interest rates, right? So because if you increase taxes, it's a very unpopular move, right? And in a couple more years, the president has to go for re-election again. So they have opted for increase in interest rates. I don't think that the US can actually increase interest rates a lot more beyond that 3-4%. And even then, it won't actually, if they do it over time, we don't believe that will actually reduce inflation prices. In fact, inflation right now, your primary cause of inflation is actually the rise in your commodity prices, right? And when we look at the rise in commodity prices, it's a combination, or what they call the perfect storm, right? Short underinvestment, shipping and logistics is tricky now, right? they've created so much money now because almost 99% of the commodities in the world are priced in US dollars. So they factor in that depreciation as well. And of course, labor shortages as well because of COVID. So when you have factored all this in, commodity prices are really the source of where, right, your inflation is getting hit right now, right? And then you factor in the most recent Ukraine and Russian conflict that we're having right now, when they're sanctioning oil and things like that, that's probably going to increase commodity prices even further. Yeah. We don't think this is likely that interest rate, they won't cut interest rate, they'll change their mind and say, no, let it flow. But we think that right now the increase in interest rate is very much a knee-jerk reaction. I think the market has overreacted. I personally believe that inflation is here to stay. It will remain high as long as commodity prices remain high. Inflation is also here to stay as long as lawmakers or central banks continue to create money with no restriction, right? That is your main source of issue, not interest rate, okay? So with this tapering tantrum, is it a good thing or a bad thing? To be honest, I see this as actually a very good thing, right? If central bankers are brave and willing to actually increase interest rates, we've seen it time and time again. Even when they increase interest rates, there's a small knee-jerk reaction. Typically, if you look at the indexes, markets recover and they go higher than their previous high, right? You look back and back test the data. You're gonna find this is gonna be true, right? So I guess the question here is, what do you guys think, right? Do you guys think it's an opportunity now, or is it a threat? Okay, I've just presented you a quick summary here, but do you think it's an opportunity right now or a threat, right? In terms of timing. Yeah, so give me a second. I think it's a bit of echo. So maybe if you guys can give us some feedback. Just, do you think it's a threat or opportunity at this point in time? If you guys can put in the comment section below, that'd be great. Okay, all good. Sound okay. All right, so you can see the really only thing that that really affects interest rates going up is really only your bonds, unless you have a big portfolio of bonds. I think this is a little bit overdone. Yeah. Okay. This is the conclusion in terms of this economic session. I know it's a very short one, but I wanted to give you guys a gist of it. Now, if you look at this is actually the long-term trends, right? Long-term trends. If you look at the black line, that's the growth of M2 supply or money supply, right? You're going to realize that the main source of inflation today, and it's very clear here, when they increase money supply in such a sharp instance, if you look at what happened in 2020 and 2021, they increased the money supply by almost 25% in 1 year. It's never happened before in the whole history of mankind, right? Whole history of mankind, it's never happened. Even they said now they're going to slow down, right? If you look at that, they've increased it 25% in 1 year. They're slowing it down to 10%, but that 10% is still based on a much higher base. I want to remind you. So as long as they keep continuously to create money, you're actually going to see that red line being inflation. That is definitely moving up, right? And that's what we're feeling today. In fact, I gave this presentation last year when you look at the amount of money that's being created, and that's why commodity prices are going crazy, and that's why crypto as becoming a more important or emerging asset class, right? Because you have just so much fiat money print everywhere. It has to go somewhere, right? So when it goes somewhere, you're going to inflate assets. So we are definitely bracing for higher inflation. Of course, those of you who have a portfolio of commodities in your portfolio, likely you will be on the right track. You will likely outperform the market this year, right? I think those are the kind of unloved stocks, right? So In the case for Singapore, you do have one very major commodity player, which is Wilmar, right? When I talk about palm oil, of course, they are oil and gas stocks as well. So, of course, for those of you who don't know, if you want to check out Singapore stocks, we've actually created a website, right? You can go to sgx.equitystracker.com. You can go and check out all the commodity-related stocks. They're actually all there, right? Now, let's talk a little bit about what Singapore is doing. I think Singapore is a little bit pragmatic in their approach, right? Historically, Singapore has always kept interest rates low, right? And their inflation is also been actually fairly low. So how is it that they're keeping interest rates so low and yet inflation is not through the roof, right? That's because Singapore doesn't work as much on a populist kind of government, right? Where the same government has been in power since their independence, right? So they take longer term views, or they make longer term policies instead of populist policies just so they can win elections, right? So what Singapore has actually done instead of increasing interest rates, they know inflation is going to kick in. So what they have actually done, which is very difficult for governments to do this, right? When you only have a 5-year term, you cannot think long term, and that's really the problem. But because they have been in power for a long time, and I think they are quite comfortable, but they're doing the hard things today, right? For the better of tomorrow, right? So very pragmatic of their approach. So what they have done is that because Singapore is really a bedrock for money flow, right? So a lot of money actually comes into Singapore as a financial hub. And one of the things they have actually done, right, is actually they've said that they're going to increase GST, right? Now, this is absolutely unpopular, right? If you look at what happened in Malaysia, we had a change in government because of GST, right? A lot of people are opposed to GST. But they said, look, right now it's 7%. Next year, 2023, it's going to go to 8. In 2024, it's going to go to 9, right? So they're going to stagger and increase taxes. So this is actually going to reduce money supply, right? So instead of increasing interest rate and really messing with the whole economy, they're doing it with a more surgical approach, right? So they're actually increasing GST, and that will bring in revenue for the government as well, right? So that's how they kind of reduce money supply in that space. What they've also done, really, in part of their taxes, they actually increase carbon taxes, right? So those high polluting companies, they're actually taxing them more, right? And they've given a timeline for 2026 to 2030, right? How much taxes governments, how companies will have to pay if they are polluting the environment, right? So they're trying to achieve net zero emissions. The third one that they've done, which was quite smart, was they tax the wealthy, right? So since a lot of these wealthy guys already have so much money, right? They're also very asset rich. They are actually going to raise property taxes, also for residential properties, and also income taxes. Now, but when they say raise income taxes, around the region, Singapore has generally fairly low income tax rates, right? So by them increasing it a little bit is really not going to move the needle, but they're doing this more surgically, right? So they're gonna be increasing taxes to those who can take it, can afford it, right? Because they are still in the recovery process. You can't tax your B40 or M40, right? So they're actually looking at T1.2%, right? That they will be taxing those guys that can afford it, right? And of course, I think only in Singapore, owning a car is a luxury. So they're actually planning to increase taxes on cars as well. I mean, funny thing is that if you look at Singapore, the amount of money they collect on taxes a year from cars is more money than Toyota's annual net profit, right? And they don't even have to produce any vehicles. It's just a tax, right? So those are some of the things that they've done. They have also, they're actually trying to also control inflation a little bit, but they're going to do very selective, right? That means reduce their dependence on foreign workforces. So they're trying to improve local employment, right? So this is more for Singaporeans, right? And of course, I think this is a very small amount, but they've actually reduced business packages. So they have a $500 million support package versus 2021, 2022, 28. So that means they've reduced the expansionary, right? So they're not creating more money, right? So they're taxing it, right? But they're not going to increase interest rates, right? So that's really what they have done. So the forecast right now is a 3 to 5% GDP growth in Singapore. So they're taking a much longer term approach to this space, right? Now, so obviously, we're going to be asked, what are the winners, who are the losers, right? I think generally in this space, I think there's no clear winner. Although this is a summary. There was an article that Bloomberg actually covered, and we kind of just summarized it here. I think what we're going to see is that because governments around has printed so much money in this short period of time, they are now, in Malaysia, they have Cukai Makmur, right? For 1 year, any company with more than 100 million in profit, they're going to tax them even more, right? So I think this one-off special gains tax will happen. In this case, for Singapore multinational companies. So if you only pay, say, 12% where your country is, and you bring it back to Singapore, but the tax rate is 15%, they will tax you the differential of 3%, right? So those companies that are multinational, that operate globally, but Singapore is the HQ, these companies will likely pay a heftier tax, right? Obviously, if you are in that luxury space, especially for car dealerships or distribution, it should affect you. But I generally don't think that impact is going to be that great, right? Especially for cars. It's certainly, if you look at what happened in 2020 and 2021, I think what was most surprising, and we covered this last year actually, we looked at luxury watches, right? If you look at luxury goods, actually their prices went up 2 to 3 times during a pandemic, right? So what does this tell you, right? That when you create so much money, really, the rich only got richer. Okay, the M40 actually got poorer, the B40 actually got poorer, but the rich got richer, right? So I think even with these small taxes, because they created all that money, right, it has to go to somewhere. So those with assets, they would have gained the most, right? Those without assets, they were paycheck to paycheck. They actually did not benefit from this increase in money supply, right? So you're going to see property probably taking a hit in Singapore, right? Property developers, if you're based in Singapore, because of higher tax rates for property. So those who can afford property in Singapore, right? We're not talking about HDB. We're talking about privately owned properties, right? I think generally consumer stocks is unlikely going to change. I think consumerism will still be there. When you look at GST, 7% seems very high. When they started off, it was 4%, right? But I think all this is quite relative, right, to the economy, right? If you look at Australia 22 years ago, when they first introduced GST, they started at 10, right? Nothing lower than 10, right? In Malaysia, when we implemented in 2015, and then we took it off in 2018, we started at 6%, right? So now they're going from 7 to 9. Although it'll bring them more revenue, but that 2% is actually going to be very, very minimal impact. So I think the consumer stocks, not to say they're clear winners, but I think they are going to be status quo. It's not going to be affected. So if you look at globally, 180 over countries today in the world has implemented GST. In a very short term, you might see mass buying before the implementation because everyone wants to save a little bit of tax, and then it'll slow down for 6 months. But things kind of generally smoothen over the longer term period. Actually, consumption actually doesn't come down. In fact, it goes up, right? So really, I think the GST will have little or no impact in the longer term for some of these consumer stocks, right? Now, of course, companies that invested very early in this carbon neutral place will definitely benefit because they will now have lower costs, right? That means they are able to maintain their costs. The sooner they can become carbon neutral, the less taxes they will have to pay, right? So I think generally in all, these are some of the companies that have started that net zero. Last night we had an oil and gas company, right, that is trying to go net zero emissions, right? Because I think in this space going forward, if you're investing, ESG is going to be a very, very important play as part of your investment decision as well, personally, and also as an analyst looking at companies, right? ESG is going to be a very, very important part because now we have taxation to deal with, or going forward, you're going to see carbon credits becoming more and more important that you cannot ignore, right? In fact, in Singapore, they set up their first carbon credit exchange, right? So you can actually, next time you look at a portfolio, you might have stocks and you might be trading carbon credits as well, right? As an investment vehicle. Or you might be investing in companies that actually produce carbon credits as a source of revenue as well. I think that's going to be a very, very real thing, and there's very much an unstoppable trend going forward. Yeah. Look, I hope you guys enjoyed. I enjoyed yourself. With just a little bit under an hour, but if you guys have any questions, I'll be happy to answer them. If you guys have any questions, I'll Christine, can we give them a copy of the slides as well? Yeah, I'll give them a copy of the slides, right? So we'll share the link shortly. Just let me kind of just stop sharing this, and then I will share this out. If you guys have any questions, love to. Did you guys find this session useful? Because I think we get a lot of questions on this tapering tantrum and really what's our take and how does it affect the economy or impact stocks. I think really after this kind of knee-jerk reaction, we're likely only going to see an upward trend in terms of the equity markets, right? So this is, in my view, it's very much a temporary setback or temporary opportunity, right? So you guys can check out all the links, and then we'll be sending through the. Yeah. All right. I mean, if you guys don't have any questions, maybe just give me a thumbs up if you guys enjoyed this session and you found value in this session. Trying to break down economics into very simple terms. That was my objective to help you out. Yeah. Where will gold be? I think if you look at inflation, when you look at inflation, you're going to see that commodity prices, if you consider gold as commodity or store of value, that will also likely go up, right? Historically, you'll see that. But, gold is a funny thing, right? I think if you look at gold, you're only probably looking at Generation X at the oldest guys that will buy gold, right? Or people. So if you're from a silent generation, greatest generation, baby boomer, maybe Gen X, you will value gold. Anyone past Gen X, gold actually does not make sense to them, right? So I think gold, even though in a shorter term, it may go up, as long as central banks still hold them. But I really highly doubt going forward in the next 50 years, the importance of gold as a store of value is really going to be there, right? Apart from maybe cultures like India, where gold is very much part of their culture, right? My guess is probably digital gold is going to be your next stop, right? Okay, Darren. Since CPO prices, look, right now 6,007 or 7,000. Here's a funny thing, right? Last year when we covered palm oil, it was super boring. Almost every analyst out there was bearish and said that it'll go back to 3,000, right? I think ET was the only one that was absolutely bullish on this commodity super cycle, and now we're seeing some of the results of the analysis we did last year. Today, if you ask me 6,007, now analysts are saying they'll go to 7,000, probably even 8,000. I think that's probably way too bullish, in my opinion. Why? Because you must look at competing edible oils. You must look at that, right? When you're more expensive than soybean, if you look at statistics, they call it reversion to the mean, right? Never before has palm oil sustained for a long period of time where it's more expensive than soybean. If you ask me, 6,700, 7,000, maybe in the short term. I think post all these labor shortages and everything else, I'm thinking it will settle probably at 4,000, possibly even 4,500, right? But even at those levels, it is super highly profitable for the existing palm oil players, right? Because their cost is probably 1,800, 2,000, right, or less than that. So if you look at the actual value, the profit margins that have come through, of course you minus out the taxes, and depending where you are, I think that will probably settle at that level, right? The also reason why palm oil is skyrocketed is because Indonesia has have a very firm stance that they don't want to export crude palm oil, right? You don't know, tomorrow, next month they might say, hey, you know what, the price is too sexy to ignore. Maybe we just let them export crude palm oil for 3 months, right? So we can collect even more taxes, right? Because Indonesia is trying to build their downstream, right? So from upstream all the way downstream services, they're thinking more long term. So right now, Malaysia is really the only beneficiary for palm oil in terms of CPO today, right? So you're going to see a lot of plantation companies. Even in Singapore, you have Wilmar that's listed in Singapore, right? They are going to be major beneficiaries in this short run. So don't forget, palm oil prices were already high last year, right? Now it's gone super ballistic, right? So so I hope that answers your question. I think in the longer term, 4 to 4,500 is still extremely highly profitable for these companies. Yeah, I don't believe it'll go back to 2,000, 2005. Because every 10 years, you're going to see a shift, right? So it was like 800, 1,000 for 10, 15 years. With inflation, it goes down to 2,000, 2005. Your next step is maybe 3,500, 4,000, right? That's really where we're at. So it's actually a natural inflation. And especially with the amount of US dollars being printed, I think that will be that reasonable value that will land at. All right, look, thank you very much, Tianming, Thrift Shop Babe, right? Jesse, right? Thanks for tuning in, guys. I hope you guys enjoyed yourself. Don't forget, every Tuesday we'll be back. Now, before you guys leave, I have a very special announcement. Don't leave yet, right? This month in March, Equities Tracker will be hosting an Singapore Trading Festival, right? Collaborating with the SGX, the Singapore Stock Exchange. So we have 4 days. We have tons of speakers lined up as well. I will also be speaking, right? You want to know about the next $1 trillion industry, which is semiconductors, and where you can find value on the SGX. I will be doing a session on that with Benny, right? My colleague. So if we have Singapore Trading Festival, is absolutely free. All you have to do is just register for it. Okay. So my colleague Christine will send you a link. It goes so Singapore Trading Festival 2022. We'll be posting the link shortly in YouTube and also on Facebook for those of you who are signing on. And register for it. It's free. It's going to happen end of this month, over 2 weekends, right? So you can log in. And you can watch any speakers you like. There are breakout rooms as well. We've got excellent speakers, right? So if you can post that link, that'll be great. All right, don't forget to sign up for it, okay? This month, right? This month. And tell your friends about it as well. We're also giving out some prizes as well. So if you guys attend some of the sessions, you might win some prizes. We have a couple of international speakers coming on board as well. So this is in collaboration with the Singapore Stock Exchange. So they brought in some pretty decent speakers. Equities Tracker will also be is the organizer of the event. All right, Christine, you want to share the link? Yeah. Okay. Before that, I'd like to thank all you guys for tuning on. Don't forget to check out sgx.equitiestracker.com. It's also on that page as well. All right. So check out that link. Register. It's free. Tell your friends about it. All right. So we'll be posting that on YouTube as well in a short while. So those of you who are on YouTube, just hang on a sec while we post that out for you. All right. Yeah, click on the link. It's absolutely free. Just register. All right. Exciting prizes and good content. Okay. Are we gonna post on YouTube as well? Okay. All right. So we'll see you guys back here in a couple of weeks. Don't forget to mark your calendars. Every Tuesday, we have or every other Tuesday, we have something regarding the SGX that we have lined up, and interesting topics. Yeah. And don't forget like, follow, and our Facebook and Instagram for latest updates as well. Okay, still waiting for a link. Hang on, Kong Yap. I'm also waiting. Okay, there we go. That's the link that's just been posted, both on YouTube and also on Facebook. Right, click on that link, register. I will definitely be seeing. I think there's about 25 speakers that's lined up. So do join us, and you can do it from the comfort of your own home. All right, look. Thank you everyone for joining us tonight. It's great having you. I'd love to see you guys back here again. As usual, from all of us here at Equity Tracker, thank you very much, and good night, and bye-bye.